A 7.6% monthly yield sounds like a dividend investor's dream, but could this S&P 500 option ETF be hiding a massive performance drag? Here's what I think of JPMorgan's JEIP. Welcome back everyone, I'm the Swedish dividend investor. I was thinking the other day, I own 3 out of 4 JPMorgan options-based income ETFs, but I never talked much about them in detail. So I thought we should do an introduction to the JPMorgan family. The first member is JEIP, as you've probably seen before you clicked on this video. An ETF I actually owned, but I sold the whole position. As always, this is not financial advice. I'm just sharing my investing journey, my experiences and my own analysis. Make sure to pause or read the full disclaimer in the video description. With that important disclaimer out of the picture, let's talk about JEIP. The JPMorgan US Equity Premium Income ETF is an actively managed ETF. The ETF invests in companies from the US. Additional income is sought through the use of an overlay strategy with derivative financial instruments. The ETF seeks to generate a higher return than the S&P 500 index. Well, we will see about that last statement later. The fund size is 460 million euros. The total expense ratio is 0.35% and it is domiciled in Ireland. My broker takes the latest distribution and the previous 11 to get their yield. This goes up and down of course. They list it as 7.61% yield and they pay it on a monthly basis. So the original US version, JEPI, launched in May of 2020, while the European version was launched in October 2024. We could check the American version for some historical data to get a somewhat idea of how the fund performs. It is a covered call ETF, and they sell call options out of the money. The portfolio managers running the UCITS version are the same as the US version, and they have many years in the industry. Hamilton Reiner, the head of the JPMorgan US Equity Derivatives, has 39 years in the industry, 17 years with JPMorgan and 1 year managing this fund, but it's soon 2 years. On their site, they write, aims for consistent income with lower volatility. The strategy behind the world's largest active equity ETF is now available in the UCITS universe. It seeks to provide a consistent income stream from the S&P 500 index with less volatility. So, I guess the whole higher return than the S&P 500 is pulled out from someone's behind. As far as I know, their goal is to have lower volatility and beta than the S&P 500. While they hold the stocks in S&P 500, it is weighted differently. That's the active management working here. As we can see, the weighting and top 20 holdings does look a lot different. Take Johnson & Johnson, being number 6 in JEIP and number 18 in the S&P. While the S&P holds 500 stocks, JEIP only holds around 250. Let's have a chat about their portfolio allocation and option strategy. In their supplement for JEIP, they write, the sub-fund aims to invest in a portfolio of equity securities comprising primarily of companies that are domiciled in or carrying out the main part of their economic activity in the USA, and sell equity call options and or equity index call options to generate an income through the associated dividends and option premiums. They also write, the fund aims to invest at least 67% of its assets, excluding assets held for ancillary liquidity purposes, in equity securities issued by companies that are domiciled in or carrying out the main part of their economic activity in the USA. One big difference between the US and the UCITS versions of the JPMorgan option ETFs is they actually sell real options on indexes and they don't use equity-linked notes. I won't bore you with the details of ELNs. If you want me to make a video about it, let me know. Basically, it's like using swaps with counterparty risk. So, it is a real option strategy. They maintain at least 67% in direct US equities and write call options on only a fraction of the portfolio, usually around 10 to 20%, which means they don't choke off all the potential upside, like a fund with 100% coverage would. Checking the total return performance for the US version versus S&P 500 5-year chart, we can see a massive gap. JEPI 42.48% and S&P 87.93%. Now, is this a big problem? No. JEPI does exactly what it's supposed to do. You can see the drawdown is lower, and when the S&P was down big in 2022 and 2023, JEPI actually beat the S&P. What about the UCITS version? Total return since inception is 4.44%. Ouch. They dropped big during the tariff debacle and had a very hard time to recover after that. Meanwhile, in the same time period, the US version had a 13.93% total return. Comparing it to S&P 500, UCITS version, we can see the massive outperformance from S&P, 24.73% versus JEIP, 4.44% since inception. So, to break down everything we covered so far into 5 key takeaways. The core concept, JEIP, is the European UCITS twin to the massive US fund, JEPI, giving you an actively managed, low beta twist on the S&P 500, with a monthly payout sitting at around 7 to 8%. The UCITS advantage. Unlike the US version that relies on ELNs, JEIP sells direct index options while capping its options overlay to preserve capital growth, eliminating bank counterparty risk. The setup: Irish domicile, active management, and a competitive 0.35% total expense ratio. The US track record. Over a 5-year run, JEPI trailed the S&P 500's massive rally, but it delivered as advertised by reducing volatility and outperforming during major market drawdowns like 2022. The UCITS performance gap. Since launching in late 2024, JEIP sits at a modest 4.44% total return, compared to 24.73% for the S&P 500, and even lagged the US version's 13.93% return due to tariff market turbulence. Now, what do I think about this ETF? I used to own this. I bought a smaller position shortly after the launch. I had invested into the JGPI, their global version. Stay tuned for that one, when that was released. After holding it until February-March this year, I came to the realization it didn't perform as expected. Sure, I didn't think I was going to beat the market, but the heavy underperformance was just very obvious. So I sold it just above break even and put everything into another JPMorgan Option ETF. One thing I have noticed that could explain why they have a sluggish performance is the Euro-USD difference. I know there is a Euro-hedged version of this ETF, but I don't have access to that. But hopping over to just ETF again, if we change the return to USD, we do actually see a performance similar to the American version. Can I see myself owning this ETF again? Well, someday I might. My portfolio goal is to have a strong base of conservative, high-yielding ETF. Hey, I saw you roll your eyes. Meaning lower volatility, less risky holdings or weightings, kinda like JEIP. Now, I would want to see how this one reacts in the next major downturn, since they didn't manage the pretty hard crash in April 2025 that well. What place does this have in a portfolio? Like we talked about before, it's a lower volatility holding, exposed to US stocks, if you're into that. It has a monthly distribution and a pretty good yield. Ever since NEOS got acquired by Goldman Sachs, I've heard rumors about Goldman Sachs and NEOS expanding to the EU. If something like both GPIX, Goldman Sachs S&P 500 Premium Income ETF, and SPYI, NEOS S&P 500 High Income ETF got launched, I would rather own a 50-50 split between them but we have to play with the cards we are dealt. So, as for now, JEIP is a potential S&P 500 options income placeholder for me. But I want to know what you think about JEIP. Do you hold it? Have you owned it? Make sure to let me know in the comments. And if you enjoy my work and want to support me, giving a like, dropping a comment and subscribing are easy and free ways to support the channel. Make sure to hit the notification bell so you don't miss the next member in the family. That's it for today, and I will see you guys in the next one. Until then, stay smart, stay patient, and keep stacking those dividends. Ha det gött!